This video covers an introduction to security valuation. It'll cover specifically discounted cash flow methods for valuing securities. When I say securities, really focusing on stocks, common stocks in this chapter. And then the other method is relative valuation techniques. They complement each other. These techniques, one can be derived from the other, and sometimes one technique is more useful or more applicable than another technique. And we'll discuss that as we go along. So the point of this here now is that, basically the chapter says that the value of any financial asset is equal to the present value of its future cash flows. So let's map out the cash flows before we go any further. So I'm going to say it again. The value of any security is the present value of its future cash flows. And in this chapter, since we're dealing with primarily valuing stock, the cash flows that are generated by a stock are dividends. We'll also look at another technique a little later on that uses cash flows that are not dividends to value a common stock. But for now, let's look at what's called the dividend discount model. And what we should make sure we have our head on straight is the timing of cash flows. So we always start off at time zero, and then we have a period, 1 period, 2 periods, 3 periods, and so on. And a stock never matures, and so this line just continues out. We are sitting right here today, and we're going to assume that the stock just paid a dividend right at this point here. We're going to call that D subscript 0. The dividend just paid a minute ago. And we're going to assume that there's going to be a dividend 1 year from now, right here. And we're going to call that D1. And we'll assume there'll be a dividend in period 2 and in period 3. So they're all spaced 1 year apart. And we do 1 year apart because it's easy and convenient to do it that way. So here's the timing of our cash flows. Now, what we want to do is we want to look at how to value a stock. And the value of stock is going to be denoted in your textbook. And I'll be consistent here. The value of stock J is the present value of those future cash flows. That's a past cash flow here. This is a past cash flow, D subscript 0. It's the present value of future cash flows, where we're discounting it at 1 plus K, so we're discounting at the rate K, and K is often a nice easy symbol for the required rate of return on a stock. In other words, the risk-free rate plus the beta times the expected return on the market minus the risk-free rate. The capital asset pricing model. Security market line, that's K there. So it's 1 plus K, and K is in decimal form. And then we discount it back 1 period. So this right here, this term is the present value of this first cash flow. Then we want to take the present value of the next cash flow. What is it worth today? Well, the dividend in period 2 today is worth this much. This whole term is this is the dividend you're going to get 2 periods from now. This is what it's worth in today's money, reflecting the compounding of money. And we just continue. And so this continues forever, out to infinity. And so one of the problems, a couple of things you see here. First of all, K is constant. It's a constant discount rate, at least according to the model. And another thing you see is, one, we have an infinity sign, which we've got to deal with, because if we're trying to use this model in reality, we just can't. We have to get rid of this infinity sign, and I'll do that in a minute. But also notice implicitly what's going on here. Look, I'm subscripting the D's for the dividends, and the reason I'm subscripting the dividends is it means that the dividend today, or the dividend 1 year from now, can be different than the dividend 2 years from now, different than the dividend 3 years from now. So it allows the dividend to vary. If I just left off the subscripts, then you'd have a constant D, a constant dividend. And we know that stocks pay constant. They don't pay constant dividends. They may have constant growth in their dividends, but the dollar amount of the dividends can change, and it often does. It's set by the board of directors, and periodically the board adjusts the dividend based on the size of the company and the cash flows that the company's throwing off. Okay, so now what we want to do is we want to get rid of this infinity sign. And the way we do it is we assume that there's constant growth in the dividend. And what I mean by a constant growth in the dividend, we're going to assume that the dividend grows at a constant rate G. And so that basically D1 equals the dividend just paid times 1 plus G to the first power. And so what I'm doing is I'm taking this dividend here and I'm growing it by G for one period right there. And then D2 would equal D subscript 0, 1 plus G squared. So I'm taking that growth rate and compounding it 2 periods to come up with, look, here's the dividend we just paid. I know that. I can anchor on it, and I can grow it 2 periods. So now, if I plug these in, these terms in here, and I plug this term in here, and I keep doing that, I can simplify the model and get rid of this infinity sign and come down to something that's much easier to work with. Say, value of stock J at time 0. And you can forget that if you want. If you want to forget the that we're just valuing stock J, get rid of the J there, and just say the value at time 0. We're going to value the stock right here at this point in time today, and it's going to equal the dividend next period discounted at K, the dividend the next period discounted at 1 plus K squared, and so on to infinity. And so all we did was make the substitution, took out D1, D2, D3, and so on. Now I'll call this equation 1, and now I'm going to write equation 2. I'm going to multiply both sides by 1 plus K over 1 plus G. Running out of space here. So far what I did was I just multiplied by 1 plus G. And so notice what happens immediately here on this term. The 1 plus K cancels out, the 1 plus G cancels out. That's good. On here, now what happens is these superscripts here go to 1. And we get rid of this because there's the cancellation here and cancels out top and bottom, and it continues to cancel out. And so what I'm going to do is I'm going to subtract equation 2 from 1 here. So I had equation 2, and this went to infinity, and equation 1, which went to infinity. I'm going to subtract the 2 equations, and when I subtract the 2 equations, I get this. So I'm just going to subtract these 2 right here. I'm going to subtract this from this. And there I have just that side. Now what I want to do is subtract these 2 sides, these sides here. But notice what has happened is that all I have is a D subscript 0 here. So I'm going to say D subscript 0, and then this guy right here. See these terms? This whole thing is equal to this whole thing. And if I keep going here, this term would be equal to the other term that's right here that I didn't write up. But what would happen is there'd be this constant canceling. So when you subtracted the two, there's nothing here. So you just add a 0 if you want. There's nothing here because they all cancel and cancel all the way down. And so what you're left with is something, look how simple it is so far. Now all I have to do is I have to, I got to do a little bit of gymnastics with this guy, and we'll get it into a much simpler equation. And so, by the way, what I did was I got rid of the infinity sign because, and this is an infinite series. So this is just a trick that you would find in a math textbook to get rid of infinite series, so you don't have to deal with things out forever. So let's continue with what I'm doing here. I'm going to say v subscript 0, and what I want to do is I'm going to collect this term 1 plus k over 1 plus g minus 1 equals d subscript 0. That's not so bad, but now I need to get a common denominator in here. And the way I do that is 1 plus g over 1 plus g gives me that common denominator. And so what I get here is basically k minus g on the top over 1 plus g equals d subscript 0. Now I'm going to multiply both sides by the flip of this, and I'm going to get the value of the stock equals the dividend, right, times 1 plus g over k minus g. And what we have here now is the value of the stock, and your textbook is calling it V, it's really the price of the stock today, equals the dividend in period 1, because this is nothing but D1 right here at the top. And this is K minus G. And so this is the foundation for much of this chapter. So it took one page of algebra using a thick marker. So I use the thin pencil here. And I derived what's called the constant growth model, the constant dividend growth model, where I assumed that dividends grow at a constant rate G forever, and it boiled down to the stock price is nothing but next year's dividend divided by K minus G. And in this model, K has to be greater than G. And if it's not, if K is not greater than G, then that means, I mean, think about it, you can see it, possibly you can see it up here. Maybe I should rewrite it for you. If K is not greater than G, then what happens is, look, what happens is this thing will explode because you're adding this term to this term. And what happens is this term, these terms would get bigger. If G was bigger than K, then the top would get bigger, and the discounting fact, the fact that it gets getting smaller, wouldn't get very small. And so these terms would constantly get bigger. If you constantly add bigger and bigger terms, the whole thing blows up to infinity. The value would be in infinity if G was greater than K. So you can't have a growth rate greater than the discount rate forever. And that's the thing, forever. You're going to have growth greater than K for a short period of time, and many companies do that. They have that situation. But when you have a simplifying assumption of growth forever, you can't have G greater than K for very long. Okay. So now, back to let's change. Let's keep the let's get rid of the V's as the textbook does, and have next year's dividend divided by K minus G. That's our constant dividend discount model. That's what we want to focus in on. And we're going to apply this in a bunch of different areas and techniques coming up soon. But before we go there, let's look at G a little more closely, because we know what dividends are. We know what K is. We spent most of a chapter from the security market line chapter 8, talking about how K is derived, and it incorporates the opportunity cost of money plus risk, systemic risk. And now what we really ought to beat up and look at closely is G. There's a whole bunch of ways to look at G and compute G, which I think are insightful, because this goes back to the value versus growth investing. Growth investors look for stocks that have high growth rates. Stocks with high growth rates, go back to this math over here, stocks with high growth rates, a high G, means that this value is up if G is high, all else being equal. So growth investing is all about finding stocks with really high growth rates. And so let's look more closely at G. So G can be computed as 1 minus the payout ratio times ROE. 1 minus the payout ratio. Payout ratio is, you can think of it as your dividends per share divided by your earnings per share of the firm. And 1 minus the payout ratio is retention. This is percentage of retention. If you're paying nothing out, and your dividends are 0 relative to your earnings, this whole thing is 0, and so your retention is 100%. Okay, so you take what you retain, your retention, and you multiply it by your profitability, and that's how firms grow. They grow by retaining some of their money, and their profit. They retain some of the profitability, and they take that and they reinvest it at the return on equity. So you need both of these terms to be positive and greater than 0 in order to have growth. Long run, sustainable growth. And that's the point, long run, sustainable growth. Now, this concept is very similar to putting money in a bank account. If you put money in a bank account, you put $100 in an account, and it grows and you let the account just sit there, and you let the balances compound over time. And let's say it has a return of 10%. So really the growth rate of your account will be equal to 1 minus, you're paying out 0. In other words, you're retaining 100% of your money. You're just leaving it in the account. And it's growing at 10%. Therefore, your growth rate of your account balance is going to be 10%. If you instead pull out 50% of your money, so 50% of the interest that you earn, you pay out, then you're going to grow at half the rate. And so that's the way firms basically grow. Look, they're generating a profitability based on return on equity here, ROE, and they have a certain amount of retention. Okay, that's one method. This is a very common method to estimate growth. Quick and dirty way of calculating growth. Now, another way to deal with growth is to look at growth and to estimate it, look at going backwards in time. And so we can look at G, because what people do is they don't have good crystal balls. They don't know how to predict the future. And so what they do is they look backwards in time to try to get a feel for what the future will look like. So what we're saying here is, if a company has grown pretty fast in the past, it's likely to grow fast in the future. And so we're going to look at the past to help with the future. And so maybe, we calculate past growth and we tweak it up or down a bit depending on things that we foresee in the future. But by and large, people often look to see what has happened in the past. And so ultimately the growth has to do with, growth is the source of cash flow comes from earnings. So if we look at earnings per share 1 period from now, right, and divide it by your earnings per share, T minus N, I should say T here. So this is earnings per share times T, and this is earnings per share T minus N periods back. And we're just going to take the average compound growth rate over n periods. Here. Sorry about that. So really what we're doing is we're looking at the compound growth rate of earnings per share over n periods and computing it. And so, that's at first blush, okay, that's nice, and we can see growth comes from earnings per share, because when, in order to pay a dividend, you better have some positive earnings, and especially if you're going to have growth forever, you better have some earnings forever going out into the future. Get it? So that's why we need to we can look at earnings per share, but ultimately the dividends would have come from the dividends would have come from those earnings. Now we can also go further into this analysis and realize that earnings per share at, say, period 1, next year's earnings per share. So you look at the timeline again. So earnings per share over the next period is going to equal sales per share, right? Sales divided by the number of shares times your net profit margin. Okay, and so you can see that this is sales, period 1, divided by the number of shares, that's sales per share, times your net profit margin, which is net income divided by sales. And you can see, I should put a little 1 here. You can see that the sales cancel out and you get net income divided by number of shares, which is your earnings per share. This is EPS. And so what we now see is that, look, in order to have earnings per share, you need to have some sales per share and you need to have some profitability. And so we get a little more information about the ultimate source of growth. So I'm saying, look, earnings are growing, but where's from earnings per share? But where's earnings per share coming from? It's coming from sales and profitability, right? You got to have some sales and you got to have some profitability to have earnings and to have sustainable growth. Now, we can go and look at another step, one more step here. Remember, G equals 1 minus the payout ratio times ROE. What we can do is we can break out ROE a bit into its various components. And so this is a trick sometimes called the DuPont method that you may have seen in a previous finance course. And so basically it's looking at ROE is made up of profitability, turnover, and leverage. So profitability is net income divided by sales. Okay. And then, so that's profitability. And then sales divided by total assets. That's how much sales is your total assets generating? How much sales is your total assets generating? It's a measure of asset turnover. You want this number to be as high as possible. You want to have as little assets as possible to be really efficient, and you want to generate a lot of sales. And then you multiply this by a leverage factor, TA divided by equity. And so that's a leverage factor. And so notice what happens, the sales cancel, total assets cancel, and you're left with net income divided by equity. Okay. And so what I'm doing here is I'm being careful with my subscripts. You may have noticed I'm looking at your net income over the next year going forward right here as a function of your investment in equity. Okay, so it's your investment in equity. Not unlike what we saw earlier when you looked at the total return of a stock. You looked at what happened over the next period divided by your investment P subscript 0. So think of this as P subscript 0 in a sense. Now what I want to do here now is look at various stages of growth. In the constant dividend discount model, we had one stage of growth. And that one stage of growth was G. So here we had time, here we had G, constant growth forever, as you go off. Obviously not realistic, but it simplifies the math tremendously so that we have this equation. And this equation has a ton of intuition, which I'll talk about in a second. Lots of good intuition as to what's going on there. Now, you can have two-stage growth, which is a little more realistic. So you have a high stage growth when a company's young. So it starts out at time 0, it has stage 1 growth, and then it has stage 2 growth, an abrupt drop in growth. Firms cannot have a long-run sustainable growth rate that's very high for a couple of reasons. One is a firm can't grow faster than the economy, because eventually if you assume constant growth forever, and the firm has a growth rate greater than the economy, the firm itself will be bigger than the economy over a relatively short period of time, certainly not infinity. So you need to have a growth rate that's plausible when you assume constant growth forever. Okay? So reasonably low. But there's a lot of firms that when they start out are very young, they have high growth rates, but they don't last forever. And so you have high growth rates that eventually come down. Now in this case, it's an abrupt shift down, so you can think of this as a patent expiring, say on a drug. And so the growth rate is very high, drops down, or it could be, competition sweeps in really quickly and steals your business out from under you. Maybe your technology becomes obsolete overnight. And so that's two-stage growth. And then you can have three-stage growth, just as another example. And again, none of these assumptions hold, because growth, if you ever look at growth of firms, it tends to be relatively random, and which is why the stock price tends to be relatively random. One of the reasons for it. But in order to simplify the math and get the concepts down, we assume these various growth models. So a three-stage growth model would look something like this, where you have a really high growth rate early on when it's young, say for a couple of years, and then slowly, maybe as competition slowly moves in and steals your business, or you slowly saturate the market like Starbucks or say McDonald's, and eventually you come down to a long-run sustainable growth rate. So the point is, this last growth, this terminal growth rate, as it's sometimes called, needs to be a long-run, plausible, sustainable growth rate that has to be less than the growth rate of the economy. And the economy, as we know, grows between 3 to 4%, excluding inflation, and that grows 3 to 4% because of labor population growth and labor productivity growth. That growth ultimately drives your growth in earnings per share, which ultimately drives your dividend growth, which is where we're going here. Now, let's get a little bit of intuition here on this model. Oops, I'll use P. So you see that when dividends or if dividends next period are expected to go up, all else being equal, price goes up. Okay. Now, so that kind of makes sense. If D is expected to go down, then the price will go down. Now with K, if K is expected to go up, all else being equal, K goes up. That means either interest rates are higher or the opportunity cost of money. The opportunity cost of money is higher, or the systemic risk of the stock is higher. And so that causes, since this is on the bottom, it causes the price to drop. So when risk goes up, for example, stocks drop. We know that. As soon as people find out that a stock is somehow riskier, all else being equal, they're going to sell it. And if interest rates go up, that means the value of the stock drops. We can see that going all the way back to these equations here. If K goes up, it's on the bottom. It's going to cause the value to drop. And then we see here now, and also if K goes down, if K drops, it's going to cause the stock to go up in value. So let's look at how G behaves now here in this model real quickly. G is on the bottom, but it has a negative sign in front of it. And so it's slightly trickier, but you don't need to know them. You don't need to see the math to figure this one out. When a company has high growth, all else being equal, as growth increases, it's going to increase the price of the stock. You don't need to go through some fancy math to know that. And so when you have something on the bottom with a negative sign, it's kind of like two negatives essentially. So growth is positively directly related to stock prices in this model. And so lots of intuition in this model. But this model assumes and depends on dividends. Now, not all companies pay dividends. So we should look at alternative methods of valuing. I mean, technically, we could still work a dividend discount model even on a company that does not pay dividends. Because you just draw a timeline here. Say no dividend in time 0, in time 1, no dividend in time 2. Well, maybe there'll be a dividend in period 3. So the price today of the stock will be 0 plus 0 plus the dividend in period 3 discounted back 3 periods. The dividend in period 4 discounted back 4 periods, off to infinity. So you technically don't have to have dividends today for the dividend discount model to work. For the constant dividend discount model, constant growth model, you're going to need a dividend next period for sure for that to work. But what if you don't have any dividends and you don't see any dividends on the horizon for a company? Then maybe you don't want to try to use this model. That's where a free cash flow model comes in. Free cash flow, and there's various free cash flow models. Sometimes they're taught in MBA 505, which is the previous prerequisite finance course. FIN 320, I often hit it in that class. And so there's various models of free cash flow. This one's operating free cash flow. So there's a little O in here in front of it. Operating free cash flow. And basically the way to think about free cash flow is it's cash flow coming from operations that's freely available to stockholders after you consider profitability, taxes, capital expenditures, and increases or decreases in net operating working capital. So let me explain. Operating free cash flow is going to equal EBIT, earnings before interest and taxes, okay, which by the way, let me see if I can write that off here. Earnings before interest and taxes, that's sales minus your cost of goods sold, right? And that's gross margin. And then you subtract off selling and administrative expenses. And then you're left with earnings before interest and taxes, before you subtract out interest and taxes. Then what we want to do is we want to subtract out taxes. Okay, tax rate. So 1 minus the tax rate gives you what's left over in terms of taxes. This is just, EBIT is so common in the world of finance and accounting and financial statements and the annual reports that we put it in terms of EBIT and then we back out the tax effect here. So with the negative signs, backing out the tax effect. And we also want to add in here the depreciation and amortization that was deducted above, because this didn't take any cash flow. So your operating cash flow is a function of your after-tax profitability right here, plus your depreciation and amortization, which was an expense that didn't use cash. Then what you have to do is you have to subtract out your capital expenditures, because capital expenditures, remember, do not show up on your income statement. Only expenses show up on your income statement, but capital expenditures, that gets capitalized and thrown on your balance sheet. So we need to take off capital expenditures for the purchase of property, plant, equipment, for example. And then what we need to do is we need to back out your change in net operating working capital. And your net operating working capital, right here, this guy right here, that reflects changes in your cash plus accounts receivable, right, plus your inventory. So this is your the very front part of your balance sheet, as I would call it, the most liquid part of your balance sheet. You got money tied up in cash balances. So believe it or not, when you hold cash balances, there's an opportunity cost of money to hold cash balances. That's here. So you're using cash to keep it in the balance. It could be used elsewhere. So just keeping cash balances has an impact. Accounts receivable means you sold things that you haven't gotten the cash for yet. So accounts receivable cost you money because you haven't gotten cash in yet. And then holding inventory, investing in a warehouse full of inventory is using up your cash flow. And so this uses up, these things use up your cash flow. What tends to offset this cash flow is less your accounts payable, because you bought things that you haven't paid for yet. That's good. That frees up cash flow. And then accruals. Accruals, like, the easiest one would be salary expense. At December 31st, you haven't paid your employees yet because the pay period is straddled by December 31st. And so you make an accrual. You haven't paid your employees yet, but you certainly got all the benefits of their work. And so that's a positive from a cash flow perspective. Now, what we're looking at here is taking this whole term and subtracting this whole thing. So there's a negative side. We're subtracting the change in this whole thing. That's what we're doing right here. Subtracting the change. So if this is positive, this whole thing is positive. This this circle here is positive. That means we are, and the change is positive, it means we're using a lot of cash that's getting stuck in accounts receivable, inventory, and cash balances that's not working elsewhere. And so that reduces our free cash flow, our operating free cash flow. So this is a measure of our operating free cash flow that's available to stockholders. And that's cool, because notice there's no dividends in here. So this is just, firm ought to have, if it's, in business, it should have some profitability, and it'll have some capital expenditures, which will be negative. It'll have increases in working capital, which will be negative, but you got to have positive free cash flow. Now we can assume constant growth in that free cash flow forever. And if we assume constant growth, we can shrink this. We can take a model of free cash flow and shrink it down to a model that looks very much like the constant dividend discount model we just looked at. So what I'm saying is, look, you can value a stock today to be equal to operating free cash flow divided by 1 plus weighted average cost of capital, right, plus, this is free cash flow next period, free cash flow period 2, discounted by the weighted average cost of capital. And I haven't told you what weighted average cost of capital is, but you might remember that from your previous finance course, and you might not. Basically, the weighted average cost of capital is it's weighting. It's a weighted average where the weights add up to 1 of your cost of debt. So how much is your cost of debt? How much is your cost of equity, common stock? How much is the cost of borrowed money to raise capital, common stock capital? And then if you have preferred stock, it could be the cost of preferred stock. So it's a weighted average of that. And what we're doing here is a couple of things you need to get perspective on. When I say value, this is the value of the whole firm right here. This is the whole firm. And what I mean by that is this is valuing the free cash flow for the whole firm. Here we have a balance sheet. Okay. Here's your total, here's your assets, here's your liabilities, and here's your equity. Okay. What we're doing is, when we're looking at the free cash flow right here, we're valuing the entire firm. The entire left-hand side of the balance sheet. When we were valuing the dividend discount model, we were using dividends, which is the cash flow that the stock throws off, right? Just dividends. And you can't pay dividends until you've paid, until you've reflected your capital expenditures, your net operating capital, changes in your net operating working capital, and your profitability. You can't have any of that. So when we did the dividend discount model, we went and zoomed right into valuing the common stock, the equity. Now what we're doing in this free cash flow model is we're valuing this whole firm, right? What is the cash flow that this whole firm is generating from all its assets, right? We have to take from that and back out the equities, the liabilities that this firm has. So we value the whole firm, we value the assets, we subtract out the liabilities, and now we value the entire equity portion of the firm. So we take the entire equity in billions and divide it by the number of shares, and then we have a value for the common stock, which is our ultimate goal here. And if we can value the common stock assuming constant growth, so then the value today of the stock is nothing but free cash flow next period divided by the weighted average cost of capital, which is basically K. K is for the stock, the equity. This reflects the fact that your cash flows that are coming in here were generated by debt, borrowing debt, possibly preferred stock, and by equity. So you need a weighted average of all these costs. This is your cost on your right-hand side. And so not just K, because K was here. K was here in this section. So we have the weighted average cost of capital minus the growth in the operating free cash flow. Long-run sustainable growth. So therefore, mechanically, this part of the model is nearly identical to the dividend discount model, except we've substituted in free cash flow, which is the value of the whole left-hand side of the balance sheet, and we want to value equity ultimately as the goal, so we need to subtract out the debt in doing that. I have an example in a few minutes when I need to go through a few bit more concepts. I'll show you how to value the stock using this method. So basically you take this and you subtract off debt. And you divide the whole thing by the number of common shares outstanding. And then you have basically a price of your stock. So your price of your stock is your free cash flow, growing at a constant rate forever, discounted at the weighted average cost of capital, subtract off debt, divided by a number of shares, and you got a price per share. Now let's look at desirable versus undesirable growth. And believe it or not, there is growth that you can have that's undesirable. We'll talk about that. And there's the residual income model. All of this gives you more insight into what drives the value of the stock. Now, we can decompose a stock price into its no growth component plus the present value of growth opportunities. And you can look at this no growth component from two different angles. One, you can do a mental experiment and say, look, we have a firm that's never going to grow. It doesn't depreciate either, and it just generates the same stream of income, the same stream of earnings using the same assets. It's just a thought process. And so if you had a firm that did that, the price of the stock would reflect this no growth component. Okay? It's basically the value of assets in place that never depreciate. But nearly all companies, especially companies in the high-tech world, also have a growth opportunity built into the stock price. Shake Shack, it's not even a technology stock, but Shake Shack is a good example. They only have 63 stores, if I recall, and so the value of their stores, this no growth part, if those stores just stayed there and generated the same earnings year after year after year, nothing depreciated and they didn't grow anything, this would be the value, that would represent this component. But Shake Shack had a huge stock price because investors realized that Shake Shack was going to grow tremendously. It was going to increase the number of stores. It's going to increase probably the type of burgers and its menus and so on and so forth. And his business would just generate and get much bigger, probably beyond just plain old burgers and shakes. So you can think of a stock as being composed of those two components. Now another way to think of this, they said there was a second way of thinking about this no growth. You can get no growth by paying a dividend equal to your earnings per share. So your dividends per share equal earnings per share. Right? Yeah, you can, right? Because remember, G equals 1 minus the payout times ROE. And no growth means growth is 0. How do you get 0 growth? Well, you pay out dividends per share equal your earnings per share. When they equal, this is 1. 1 minus 1, this is 0. 0 times whatever the ROE is, 0. And you get 0 growth. So there's two different ways you can think about that. You can also decompose these two components into a little more mathy. This. So basically, you can think of this as, here's your earnings that are going to grow forever at growth rate 0, right? So K minus G, but G is 0. So it's, you can basically ignore that. And what we have here is, if you recall from your basic finance course, the prerequisite to this course, this is a perpetuity. Perpetuity is a cash flow that never grows and goes out to infinity. So firms can have undesirable growth. And so what we need to do is we need to look at a model that helps show growth that's undesirable. And that's where the residual income model comes into play. The residual income model comes into play. It helps us to see undesirable growth. And undesirable growth can come about by companies that have growth rates that are too low. And the growth, even though it's growing, it's not growing fast enough. And basically what it says is, look, shareholders are better off putting their money elsewhere in another company that has a higher growth rate and more profitability than the existing firm. Or another way of looking at it is, the firm is actually better off paying a 100% dividend to its stockholders if it has undesirable growth. Because what undesirable growth means is the firm is reinvesting its cash flows into a business with slow growth. And the shareholders are better off getting that retained money in their pockets through a dividend so that they can reinvest it themselves at a higher rate of return than by having the company reinvest its cash flow at slow growth. So let's actually develop the residual income model. So we start off, P equals to D1 divided by K minus G. So there's the constant growth model. Okay, but what we want to do is we want to do some math tricks to get this to a point where, and that's really what this is about. It's math tricks to get it into a formula that has a lot of intuition and to show this desirable and undesirable growth component. So what we do is we take and we add book value today per share, and we subtract book value per share. So you add and subtract it on the one side, it does nothing because it has no effect mathematically. 0 on this side. Okay, and then what we want to do is we want to multiply this term by K minus G. K minus G. And when we do that, notice what happens. We get a common denominator here, and taking K minus G divided by K minus G mathematically does nothing, because this thing underneath my finger really is 1, so it doesn't do anything mathematically, but it allows us to get a common denominator. So you'd never think about doing this on your own, but people have been playing with it for quite a long time, and so they've come up with these models. So really what this boils down to with the common denominator then is this. Okay. And so what you see here now is you have book value of the price of a stock today is equal to its book value today, which is basically, it's no growth. You know, if you assume that the value of the company doesn't grow, it's this book value in place, assume it doesn't depreciate. It's right there. And this guy right here represents the present value of growth opportunities. And so recognize, so you know what D1 is, and recognize what this component is right here. This represents the growth in the book value per share. Oh, there should be a V right here. And this component right here represents the book value, you know, your equity times K, which is the required earnings that you expect, earnings that you require to generate from your book value. So K is your required rate of return times your equity, your book value. This is what's required. Shareholders are requiring this amount of return from the book value. And so we can recognize now, another little trick here is that D1 plus the book value times G equals your earnings per share next period. In other words, this is your increase in your book value per share, right? This comes about G is your profitability, and then you take your dividends for the period. This is basically what was retained. This is your retention, and that equals, and this is all in dollars right here, in dollars. This is your retention. It all adds up to equal your earnings per share in period one. So by the way, I'm flipping around here. Sometimes I say EPS for earnings per share, and sometimes I use just plain E. Depends on what's convenient for me. So I don't get lost from that. So now, what I can do is I can substitute this right here out. And that's what I'm going to do. So I got price equals assets in place that never grow, plus my earnings per share next period, minus what my shareholders require given the risk is this component, in terms of earnings, divided by K minus G. So as soon as you see the K minus G, that means we're looking at a constant growth forever of this term. This term right here is called residual income, or sometimes called economic value added. Economic value added. And what it says is, it has a good an interesting interpretation. In order for you to add value to a firm, right? In other words, the firm has its existing assets in place, and that's fine. But in order to have present value growth opportunities and to be valuable, more valuable, the firm has to have earnings that are greater than what's required by stockholders. So the stockholders require this given the risk, and in order for the firm to be profitable, it would be worth a lot more than just assets in place. It has to have this residual income more than what's simply required by the risk from shareholders. So this is your residual income or economic value added. If these two numbers are equal, the economic value added is 0. The firm is just basically the price is equal to its existing book value because there's no growth. If this is positive, there's growth. Now, we're at a place where we can see undesirable growth. So if this happens to be negative, in other words, earnings are not sufficient given what's required by shareholders, this whole numerator can be negative. You could still have a positive growth rate in this, but you can still have positive growth, but you're going to have a negative term up top here. And what that's going to do is it's going to make this whole term negative. So that the price of a stock equals its book value per share minus this whole term right here. That's the effect of undesirable growth. If a firm is not growing fast enough, right, then shareholders are better off with the firm paying 100% dividend, paying the firm not reinvesting any of it, paying a 100% dividend, giving it to the shareholders, and the shareholders going and reinvesting it themselves in other companies somewhere else. Now, let's look at some relative valuation techniques. Relative valuation techniques come into play because they're a complement the discounted cash flow models, because you don't need cash flow per se to use these models. And so sometimes you have firms that are, maybe they're not profitable. You can possibly use a relative valuation method. And sometimes it doesn't have dividends, so you can use these methods. It's just an alternative way of looking at stocks. And also, because we're scaling, and that's what we mean by relative, we're taking the price of a security and we're dividing it by something to scale it so it's comparable from one stock to the next. And even comparing a stock price of an individual stock to an index. So you can actually do that here if you're careful. And you should only be doing this, you should only be doing comparing two different stocks or a stock to an index when they have comparable risk. If the two assets have very different risk structures, very different types of risk, then you probably don't want to do this comparison. So let me tell you the various types of techniques that are out there. We've talked about them already, some of them. And the one is the leading PE ratio. Let's look at the leading PE ratio. A leading PE ratio is this. Sometimes there's a little hat over this. And what this says is, look, take today's price. It's always going to be today's price up top. So lots of times the subscript 0 is not even in there. Doesn't even show up. So it's just price today divided by an estimate. That's what the little hat stands for, of earnings per share over the next period. This is sometimes called a leading PE ratio compared to a lagging. A lagging would be this. You'd have actual earnings in the last period. So this would be actual realized earnings. And so this would be a lagging PE because you're basically, look, you're at time 0. You got today's price right here, and you're looking backwards with this lagging PE. So it's taking a current price and looking at last period's earnings. It really doesn't make a whole lot of sense because we know from the very beginning of the chapter, if I can find it, we know that a stock, the value of a stock, is equal to the present value of its future cash flows. Notice, these are all future cash flows up here. This value is not looking backwards at all. It's completely going forward. So here you have a lagging PE that's kind of looking backwards. So this conceptually doesn't make a whole lot of sense, although it's objective because most people can agree what last year's earnings are. And the earnings should be free of non-recurring events and things, extraordinary items. It should be free of that. And so clean earnings is sometimes it's called, and it's, most people can agree on what that is. And so lagging PE is by far the most common. The leading PE depends on who's somebody's estimate of next year's earnings. But nevertheless, the leading PE is conceptually more valid because you're looking at earnings next period. The stock is looking forward and the earnings are looking forward. But the stock, keep in mind, the stock is going out to infinity. The stock price is looking to infinity. And here we're only looking at earnings over the next period. So even then, it's a little shaky, but it is conceptually better than lagging PE. So PE ratios, like the leading PE, is conceptually correct. Now, I showed you a dividend discount model. I showed you an operating free cash flow model. Those models are theoretically sound. They're theoretically sound because they take every cash flow that a stock throws off in the future and it discounts that cash flow at an appropriate discount rate considering risk. So those are theoretically correct model. So therefore, if you assume constant growth, then this constant growth model is theoretically correct. Model the value of stock. Now, we can take this ratio, or we can take this constant dividend discount model and turn it into a leading PE ratio with a little bit of tricks. And so D1 can be decomposed into payout times earnings per share for period 1. So in other words, dividends next period are a function of earnings per share times the payout ratio. And that equals, and carry over the K minus G. And so what we have now is we have the ability, let me write this a little cleaner, PO equals now payout ratio times earnings divided by K minus G. All I'm saying is this is D1. Now if I divide both sides by E1, and divide by E1, the E1's cancel. And what I'm saying here is the leading PE is equal to the payout ratio divided by K minus G. So what I'm saying is the leading PE ratio is fundamentally sound. And so people use it, they throw it around a lot. It does have underpinnings that are worth looking at. And so this is sometimes called a fundamental PE ratio because it's a price-earnings ratio that's a function of fundamentals. The payout ratio, which determines growth, G also here, and K, which considers the opportunity cost of money and risk. Another common relative valuation technique is price to book value. And the way to interpret this is, it's relative from a couple of different angles. One would be, you can see whether or not a company is over or undervalued by looking at this ratio. And you'd say, look, if this ratio is very high, then the stock is likely to be overvalued because the price is very high relative to its book value per share. Or its equity per share, historical cost basically, based on historical cost. If the price was low relative to historical book value, maybe the stock is cheap. So it's a way to scale the price by historical equity. Okay. You can also think of it as relative valuation technique because you can compare price to book for various stocks, across stocks and even indexes. Okay. So now what we want to do is we want to show that this book price to book is theoretically sound. And so we start off like we did a few minutes ago. We do the constant dividend discount model. We realize that we can decompose, remember this is payout times earnings, right? And we can break out the earnings as being equity divided by the number of shares, which is book value per share, times net income divided by equity. That's ROE. So this is book value, and this is ROE. And so what we can do now here is we can rearrange this price. Price really is equal to payout ratio times book value times ROE divided by K minus G. And if we divide both sides by book value, we get payout times ROE, right, divided by K minus G. Again, all fundamental. So this is fundamentally sound. Price to book value is made up of the payout ratio times ROE divided by K minus G. Okay. We can do one more, and there's a number of different ratios we can do this way, but let's just do one more. Price to sales. Okay. And so price to sales, again, start out with the dividend discount model. Okay. And realize that this term right here, D1, is the payout times earnings, right? And earnings can be decomposed into sales divided by the number of shares, sales per share, times net income divided by sales, which is net profit margin. The sales cancel out, and you get net income divided by number of shares, you get earnings per share. And so what you have here is you have price at this point equal to payout times sales per share times your net profit margin divided by K minus G. Now divide both sides by sales per share, and you get price divided by sales per share. We'll just equals payout times net profit margin and K divided by K minus G. And there you have another ratio, price to sales, that's based again on fundamentals: payout, profitability, risk, and opportunity cost of money and growth. Now, let's do a problem. About page 8 of the notes. Problem says an analyst valuing Green Company estimated in millions its operating free cash flow as follows. Okay, and I'll put the cash flows on a timeline. It's probably the best way to start out. It helps me to map out the cash flows. And the operating free cash flow is -5 in period 1. It is 10 in period 2, 20 in period 3. And then starting in period 3, year 3, long run growth is 6%. So basically, there's a growth rate's implied here, and it varies, the growth rate here. But then it's growing at 6% forever afterwards, long run growth rate. The firm's weighted average cost of capital, sometimes called WACC, is 10%. And the market value of its debt is $40 million. And it has 10 million shares outstanding. Okay, so that's what the problem says. And now it says determine the intrinsic value of the whole firm and the firm's stock price. So what it's doing is it's asking you this. It's saying, look, here you got a balance sheet, here you have assets, liabilities, which is debt, and here you have equity. It's saying figure out the value of the whole firm, and then figure out the value of equity. We figure out the value of the whole firm, we subtract out the value of debt, which is here, and we come up with equity in millions. We divide it by the number of shares, and we get equity per share, which is price per share, an estimate of the price per share. So, that's where we're going. That's a roadmap to where we're going. Let's solve the problem. Now, first thing you got to do is recognize, and this problem is nice in that it has what's called a terminal value that we got to get rid of. This cash flow grows at 6% forever. And so how do we get rid of the infinity sign that's here? Well, the way we get rid of the infinity sign is we do it the same way we did earlier in the chapter. And that is, look, let's determine the cash flow right here. Well, the cash flow right here is 20 times 1.06. It's going to be 21.2 million is the cash flow in period 4. And so what we're going to do is we want to value the stock right here, and then we want to discount it back. The value of the stock right here for all the future cash flows going out is going to be 21.2 divided by the weighted average cost of capital, 10%, minus its growth rate is 6%. This equals $530, $530 million. So what I just did was I got rid of all of the cash flows starting here out to infinity, boiled it all down and said all of those cash flows valued right here is $530 million. So all I did was I employed an equation that looks very similar to what we did. In terms of the dividend discount model, now I'll put it in terms of the free cash flow. Operating free cash flow in period 1 divided by K minus G. Notice that there's always this period 1, there's always a difference of 1 period between the little subscript 0 and the 1 here. Same thing applies with the dividend discount model. There's a 1 here, there's a 1 here, and there's a 0 here. There's always a 1 lag. So what I did was I estimated this cash flow right here, and I assumed it grows forever at 6%, and I discounted it at 10%, and the value of that cash flow is 530 at this point. Now what we need to do is discount this back, and here's time value of money concepts. Discounted at 10%, the weighted average cost of capital for 3 periods, and the value of this is worth, in today's money, $398.197. Okay. Now I have to value all the intervening cash flows. I got to take the present value of this, the present value of this, and the present value of this. Okay, add them all up, and I have the value of the firm right here. Value of the whole firm. So let's take the present value of $5 million. The present value of $5 million is nothing but, do it all down here, minus 5 divided by 1.10 to the 1 power. That's minus 4.545. Take the 10, discount it 2 periods. So discount the $10 2 periods. Discount that back, and that's $8,264. Discount the $20 here. Discount that at 10% for 3 periods. That present value will be $15,026. Add it all up. The whole firm, the value of the whole firm right here is $416.94. Okay, $416.94. We want to ultimately figure out the value of the equity per share. So let's take the $416.942, subtract out the $40 million in debt that we have. We come up with the equity in total is worth $376 million divided by 10 million shares. Everything's in millions here. And we get $37.69 is our estimate of the stock price per share. Let's look at another problem. Assume that high-tech companies expected to grow at a growth rate of 15% over the next 2 years, in other words, each of the next 2 years, and then in year 3, it will grow at 2% less each year until year 6, when it grows at a rate of 7% forever. The discount rate is 18%. The dividend just paid, D subscript 0 is $1. Determine the fundamental value of the firm, V. Okay. Graph the growth over time. I'm not going to graph the growth over time, but I'm going to help you do the calculations for the dividend. So first thing you want to do is draw a timeline here, and we've got a number of periods that we have to deal with, and the problem gives you what D1, D2, D3 is. I'm not going to rattle them off, but it's on page 9 of the notes. And basically what it's saying is, and sometimes this is helpful, it's helpful to put the growth rate here. 15%, 15%, then it goes to 13, 11, 9, and 7% starting in year 5 forever. Okay, so that's what we're dealing with. And so this is numerically what was described in the paragraph, 15%, 15%, and then drops 2% each period to a long-run sustainable growth rate of 7%. So now, what we need to do is we need to deal with this terminal value stuff here. Just like we did in the other problem, we need to figure out what is the cash flow here, right? And then what we can do is we can employ the model P subscript 5 equals the dividend in period 6 divided by K minus G. And so all I'm doing is, look, I got this 1 period difference between it, and I'm saying the price here is equal to the dividend paid here, right? And then what I have to do is take this whole thing and discount it back, okay? Now, D subscript 6, I gave you in the problem, it's a given in the problem, to be $1.93.5. And we're going to divide it by the 18K, which is K, 0.81. And then the growth rate is 7%, so 7% thereafter. That means this is worth $17.59. We got to discount the whole thing back at 18% for 5 periods. 5 periods. So we valued it right here, period 5. 1, 2, 3, 4, 5 periods. It comes back, and there's the 5 right there to the 5th power. The value of this whole thing is $7.69. Now what we have to do is take the present value of all the intervening dividends. And so the present value of dividend 5, right, that equals $1.808, and that's given in the problem that the dividend 5 is $1.80.08, and we're going to need to discount that 5 periods back because the dividend's coming in right here. This is right here is 1.808, and we need to discount that back at 18% for 5 periods, and that present value is 79 cents. So in other words, about $1.81 discounted at 18% for 5 years is really worth about 79 cents. And then we're going to take the present value of dividend 4, which would be right up here. Dividend 4 turns out to be $1.659, about $1.66. Discounted at 18% for 4 periods. That present value is 86 cents. And then we take the present value of D3, which is 0.909. The present value of D2 will be 95 cents. And the present value of D1, which is, let's see, $1.15 divided by 1.18, that will give us 97 cents. Add the whole thing up and we get $12.17. The value of this company, the value of this company, sorry about that, is $12.17. So I'm not going to write all this out, it's all written there. I'll give you an example of the first couple terms. You should be able to come up to the $12.17 per share. Now, the next problem is as follows. So assume that the beta on ABC company is 80.8. Okay, so beta 0.8. Its earnings per share and dividends per share next year are expected to be, so dividends per share, earnings per share, $1.20 for dividends per share, and earnings per share are $3. Let's see, a review of the firm's financial statements indicate that net profit margin is 3%. Sales to total assets is 2. So for every dollar in total assets you have $2 in sales. And total assets to equity, a measure of leverage, is 1.67. So in other words, our assets are 1.67 times equity. So you can think about that in terms of your balance sheet. Assets, liabilities, equity. This side here is 1.67 times bigger than that component right there. Okay, let's look at what else it's saying here. The ratios have been stable in the past and are likely to remain stable. Okay, so that's good. And at the same level as in the foreseeable future. T-bill rate is 2%. And the market's expected rate of return is 12% per year in the foreseeable future. Compute the company's no growth component of its stock as well as its present value of its growth opportunity. So it's telling you, look, price is equal to no growth value plus a present value of growth opportunities. Those two components. So let's just start hammering out with the data that's given to us. It's screaming security market line, capital market line, and determine K, which is 2% risk-free rate, plus the beta times 1 minus the return on the market. Here we get 1% is K, required rate of return on this stock. Oops, it's not 1%, it's 10%. 10%. Okay. And let's see, let's compute G, because it's also screaming. Given the data here, it's giving you the components of ROE. And from here, we also have the components of payout. And so we ought to be able to compute 1 minus the payout ratio times ROE. So that equals 1 minus $1.20 over $3 times ROE. And ROE is the net profit margin, 3, times the turnover, 2, times the leverage of 1.67. That equals 6%. Okay, so the growth is going to be 6%. And that means the price is going to be $30. So therefore, the price up here is $30. Right? The no growth component we know is E1 divided by K. And E1 is earnings per share, $3 divided by K at 10%. That's also 30, which means the present value of growth opportunities has to be 0. I wonder why that's 0. Well, let's look back here. Here we see K, the required rate of return on the stock is 10%. Okay? The return on equity of the company happens to be right here. This is 10%, right here, return on equity. When K equals our ROE equals ROE, what that's telling us is what the investors demand, given its risk, is exactly equal to what the firm is paying off. Investors are just satisfied with the growth. In other words, the growth is not too good, it's not too bad, it's just right. It's really at the no growth area. So what I'm saying is the present value of growth opportunities are 0 because your residual income is 0. Remember what residual income looks like. Let's see if I can pull that slide. Residual income. Actually, I'm finding the slide, so I'll show you the formula here. The residual income model says that the price of the stock is equal to its book value, no growth, plus earnings minus the book value per share times K divided by K minus G. And I'm telling you this whole component is 0. It's 0 because the earnings that the firm is actually generating is equal to what's demanded by investors. So the residual income, the economic value added of this firm is 0. It's not negative, so it's not like it's undesirable growth. It's not, this term is not positive up here, so it's not desirable. It's in between. And so the present value of growth opportunities at this point is 0. Now in the real world, you don't want to have a stock like that. But when the market is in equilibrium, stocks are priced according to this. K is equal to the required rate of return. But in the real world, you really want to find stocks. If you're looking for bargains and you're a growth investor, you're a value investor, you're trying to find stocks that have a present value growth opportunity, right? That has not been recognized yet by the market. So you have the ability to predict this PVGO faster than other people. in which case then you have a bargain. Okay, one last problem, page 10. I give you a forecasted income statement. Note it's for the year ended September 30th of 2015, and I give you a balance sheet as of September 30th, 2014. So the income statement is looking one period ahead. So you can think of it as basically here we sit, and here's September 30th of 14, and then period 1 is ends September 30th of 15. So you can think of it that way. And so you get the balance sheet, you get the income statement, and it says the company plans to pay a dividend of $1 per share for the year ended September 30th, 2015. The number of shares of common stock outstanding equals 250 shares. The risk-free rate is 2%. The expected return on the market is 10%. And XYZ's beta, XYZ is the company here, it has a beta of 1.25, so it's 25% more volatile than the market. In terms of systemic risk, growth is expected to be consistent in the foreseeable future. Okay, so it's telling us to use a constant growth model is basically what it's telling us. And the first question is, so you can read between the lines even before you get the questions. It's setting you up with all the information that you would see in the security market line, the estimate growth, and so on. So the very first question is compute the firm's return on equity and the firm's growth rate. The return on equity would be the net income of the firm divided by equity, right? And so we can do that on a per share basis. In other words, you could take net income divided by the number of shares, equity divided by the number of shares. But when you divide top and bottom by the same number, it doesn't do anything. So why don't we just plug in the numbers whole as given off the income statement? And by the way, I mean, this is a relatively realistic assumption that you'd be getting a balance sheet and income statement to do these computations. It's not like in the real world you just get a paragraph and it gives you a little bit of information. Here, this problem gives you realistic financial statements. So, net income is $600 for the year. Equity, right off the balance sheet, there is $5,000. Therefore, return on equity is 12%. The growth rate is, remember, 1 minus the payout times ROE. And the payout ratio, let's see, it's telling us the dividend is $1.50 per share. And let's see here, what are the earnings per share? Well, the earnings per share are $2.40. Okay. And how do I get 240? The earnings per share is, you got $600 in earnings, number of shares 250, and so that's $2.40 earnings per share. We times that by the 12% ROE, and we get a 4.5% growth rate for this firm. Okay, part 2 is compute the firm's required rate of return, K. Okay, which equals required rate of return. Okay, and that's the risk-free rate plus the beta, 1.25, times the expected return on the market, 10, minus the 2% risk-free rate. We do that calculation, we get a 12% K. Okay, now, question 3. Assuming constant growth at the rate computed in number 1 above, into the foreseeable future, compute the fundamental value of the firm. And the fundamental value of the firm, assuming constant growth, is this. And so we know that the dividend next period will be $1.50. It tells us that. K is 12%. The growth is 0.045. 4.5%, and that means we have a $20 price, an estimate of the fundamental value of the firm. Okay. Now, next question. So that was part 3. Part 4 says compute the payout ratio are using the payout ratio, compute the firm's leading PE ratio, price to book value per share, and price per sales per share. So leading PE equals, remember, we computed it, payout divided by K minus G. The payout ratio turns out to be this number right here. Payout ratio right here. That is 0.625. It's the dividends per share divided by earnings per share. So 0.625 divided by K. So that means, in other words, 63% of the earnings are paid out in that particular year. K is 12, and growth is 0.045, and so we come up with a leading PE of 8.33 times. It's times because, and I didn't mention this earlier, but you ought to be able to see it. When you have a dollar sign divided by a dollar sign, the dollar signs cancel, and all you have is a number. And that number is the price. How many times greater is the price than earnings? Well, the price at $20, and we can verify this, another way to look at it is, the price at $20 divided by the earnings per share next period, which are 240, shows that we have a price that's 8.3 times greater. 8.33 times greater. Just do the calculation, double check it. There it is, it's 8.33. Okay, now it asks for price to book value. And by the way, price to book value, I often leave out that little symbol. It's a leading book value, meaning it's the book value going forward. Sorry, but almost nobody ever says the leading price to book per share. It's almost never said, and so I often don't often calculate it and put the little subscripts in there. But we know from the formula before that the payout ratio, that this is the payout ratio times ROE times K minus G. And so this is 0.625 times 12 divided by 0.12 minus 0.045. And we end up, I should put a decimal there, we end up with price to book value of $1. Look at that. And so we can double check that. Let's double check that. So price to book value, the price we estimated, fundamentals, $20, right, from above, divided by book value. Now book value is the equity per share. The equity is 5,000 right off the balance sheet. 250 is the number of shares. And what do you know? It equals 1. Okay, and that's 1 times, by the way, because the dollars and the dollars cancel out here, and so the price is 1 times the size of the book value per share. Okay, got another calculation here. Next one is price, let's see, price to sales per share. And again, that's a leading price to sales per share, but nobody ever calls it leading price to sales. They just call it price to sales. And you have to figure out in the context of the problem given whether it's leading or lagging. So we know that this formula is the payout we saw before times net profit margin divided by K minus G. We know that payout is 63%, and the net profit margin, what is that again? Well, that's got to be net income divided by sales, right? And that's going to be 600 divided by 10,000. That's got to be 6%. So 0.06, net profit margin, 6% profitability. K is 0.12, growth is 0.45. We get all said and done. This is price to sales is 50.5. I almost said 50%, but again, it's a half. It's times, and it's a half. In other words, the price is only half. The price per share of the stock is only half the size of the sales per share for the stock. And we can double check that by saying, look, we know what the fundamental value, the price is, and we know that the sales are 10,000, and we know there's 250 shares, and we know that's 0.50. Okay. Question 5, the very last question says, compute the present value of growth opportunities. What are they? What is the present value of growth opportunities? Well, we know that price equals no growth, which is estimated as earnings next period divided by K. It's a perpetuity, assuming there's no growth, plus the present value of growth opportunities. We estimated price to be 20. Earnings per share going forward are the net income. Well, it's actually I don't have to compute it. We computed it a few minutes ago. It's $2.40. It's the 600 divided by 250 shares. Okay? Divided by 0.12 plus PVG is what we're looking for. So we do the calculation. It turns out that 20 equals 20, which implies that the present value of growth opportunities equals 0. I wonder why that is. Well, if you go back into the notes, we've said that when K, the required rate of return on the stock, given its risk, equaled the return on equity, then that led to a present value of growth opportunities of 0. In other words, the residual income of the firm, or the economic value added, is exactly 0. It's not positive, it's not negative, because the firm is earning exactly what investors demanded it to be earning given its risk. And so the firm has a price that's equal to its no growth component only at this point. And so present value of growth opportunities are 0. It may be a little disconcerting that the present value of growth opportunities for this stock is 0, but it's not that bad. Because think about it, you are earning K, the rate of return that investors require given its risk. So you may look at this and say, wow, there's no growth priced into it. Well, yeah, in a sense, there is no present value of growth opportunities priced in it, but you're still earning K. 12% of the stock is what you expect to earn. No more, no less.